So here's what you're going to learn today from this webinar. About 30 minutes, we're going to cover cash flow analysis formulas for rental properties. We're going to discuss potential rental income versus net rental income, what the differences are there, typical expenses of a rental property. And then finally, as we wrap it all up, we're going to talk about debt service because there's a lot of confusion. What debt service is, what does it mean? And we're going to cover that towards the end as well. Okay, so I always like to kick this off with a story from 2008. When we think back to 2008, there were a lot of people that were utilizing, prior to that, there were a lot of people that were utilizing this very easy to get financing to buy a bunch of properties and turn them into rentals. People were buying them 100% financing. They were using stated income loans. And really what all that culminated, it's funny now, but what all that culminated into was the crash of the entire real estate market, which was ultimately the result of people leveraging too much on properties. And when I was in that market back then, one of the things that folks were really focused on was appreciation. They were buying for appreciation. And when you think about appreciation, that's not a guarantee. And a lot of people were buying highly leveraged properties. They were doing 100% financing. They were having big mortgage payments on their property. And they were hoping that, which was happening at that time, that by owning it simply for 2, 3, 4 months, maybe a year, they would be able to appreciate, and then they would sell that property for a big profit. Well, back in 2008, all those inexperienced investors, when the market turned south and they were unable to sell those properties without taking a loss, then they were in a really bad situation, which ultimately caused a foreclosure. So the number one lesson I've learned from the recent or the 2008 to 2010 downturn is that when you buy investment property, your number one goal really should be to generate income, monthly income on that property. In other words, you buy it and you have enough equity in the property that your income is higher than your expenses. And that's why we're going to talk about this today, is how to analyze cash flow. And what I heard and learned was that there was a term for a property where their expenses exceeded their income, and we call that an investment alligator. And the reason it's called an alligator is because, as you know, alligators chew things up. Well, that property, that rental property, started chewing up the other income that that person or that investor had. In other words, their paycheck or maybe income from other assets, because they had to keep feeding that alligator. That investment property was costing them money every month rather than making money every other month. So I like to stress the fact that we're focused these days on monthly income. The appreciation may come, it most likely will come, especially in my market, but it may not come. And to just bank on appreciation isn't the soundest strategy if you're losing money every month trying to get to that appreciation. I want to take a moment to talk to you about our webinar that covers exit strategies for owners of appreciated rental real estate. You see, when we sit down with folks, generally they've owned these properties for 5, 10, even 30 years. And what they tell us is that they're just tired. They're tired of the telephone calls. They're tired of the toddlers, the termites, the taxes, the terrible teas. You've heard it before. And so they want to know what their options are. There's a lot of information out there on the internet, and a lot of it's untrustworthy. So that's why I created a 60-minute, easy-to-watch webinar that covers your exit strategies if you own highly appreciated rental real estate. So if you have questions and you're looking for some of the fundamental options, register. It's easy to register. Just go to rentalownerworkshop.com. rentalownerworkshop.com. It's an hour-long pre-recorded webinar. You can watch it from the comfort of your home. If you have any questions through the program, you can actually submit your questions, and then we'll follow up with you. After you register, we'll follow up with you with a telephone call or an email just to see if we might be able to give you some additional information. So rentalownerworkshop.com. Hope to see you there. Take care. And so here's the formula that we use in the CCIM world to analyze a property. This formula will also be used to put a value on a property, which will be the the topic of another webinar that we're going to complete here. But the formula is this. It starts off at your potential rental income, and then it goes through a series of steps all the way down to your pre-tax cash flow. Now, that's where we're going to stop. We're not going to go into tax because I'm not a CPA. This is not a tax class, and I would just probably cause confusion. So we're going to stop right at pre-tax cash flow, or your cash on cash return. And we're going to break this formula down one item at a time. So what is the top number? Well, that's your potential rental income. What is potential rental income? Well, that's essentially what your rental property should be able to make on an annual basis. Now, there's a couple ways to figure out rental income. One is you can go into the marketplace and you can find out what does a single family rental property with 3 bedrooms, 2 baths rent for in this market. What should a condo or an apartment that has 2 bedrooms and 1 bath rent for in this market? So you could go out into the marketplace and find out what rental income should be. And then, of course, do the numbers and figure out what your potential rental income is. Another method is, in this scenario, we have one of my clients who owned a 6-unit apartment building. And as you can see, we have what's called a rent roll here. Now, a rent roll is nothing more than what the rents are, the tenants, who the tenants are, the unit numbers, what the deposit is, all of the information that a property has on it for what the tenant list is. That's what's called a rent roll. So if someone asks you for a rent roll, they're asking you for a list of the tenants and a list of all of what they're paying in rent and all that detailed information. As you can see here, we have tenants 1 through 6, or units 1 through 6, and they're all paying something different. Tenant 1 is paying $2,000. Tenant 2 is paying $1,850, all the way down for a monthly income at the bottom of $7,950, $7,950, which would be your potential rental income on a monthly basis. However, when we analyze these properties, we like to analyze based on an annualized basis or a yearly basis. So what you need to do is you need to take that monthly rent and then just simply multiply it by 12. So here we have the $7,950. We multiply that times 12 months and come up with a number of $95,400. So we have our first piece of the puzzle for the cash flow analysis. One of the important pieces, the potential rental income for this property is $95,400 annually. Next, we need to figure out what the vacancy and credit losses are. Now, vacancy and credit losses, what they are is it's income loss due to vacancies over the course of a year, or credit loss, maybe a tenant was unable to pay. With the recent pandemic, that's become an issue. So typically there's another number that's assigned to this number of vacancy and credit losses. And again, that can be found with comparable properties that are in the marketplace. Lenders like to use what a standard of 5%. It's always expressed as a percentage of 5%. And kind of the benchmark that lenders use, at least in Southern California where I am, they use 5% as a vacancy standard. Now, if you get into markets where there's a lot more supply and not as much demand, vacancy can go up to 20%. It could be 15%. There could be wide swings of vacancy, which could be an issue. If a market gets especially popular, think about like Florida or Texas, and they have a lot of room to build, and a lot of developers go in there and just build and oversupply the market with new inventory. What you're going to see is those vacancy numbers go up. So in this situation, though, we're going to use a vacancy number of 5%. So we take 5% of that annualized potential rental income of $95,400. And so your vacancy factor in this situation is $4,770. And that gives us what they call our effective rental income. Our effective rental income is nothing more than the potential rental income. You back out of there that vacancy factor, and then you come up with your effective rental income. Now, after that, we got to talk about other income. What other income aside from rent could a property generate? Well, one of the more popular ones is laundry income. Many properties have laundry rooms attached to them where owners don't provide those services for free. They usually put some sort of coin-operated laundry in there, or maybe they hire a laundry company that they lease the equipment from. Whatever the case, there could be some additional income from laundry. Garages are another source of additional income. If some tenants don't need the garages, the owner could possibly rent those out to other tenants in the building for a higher price. And, we always know that storage or parking spaces are a premium. So garage income is another one. Parking income, for instance, maybe someone has 2 cars and there's extra parking spaces in the facility. Then you can utilize parking income, storage income, utility billing, which is very popular today. Utility billing is where you are, as a owner, able to charge back your tenants for things that are common bills that you're required to pay, like water is the big one. Utility billing for water. And then cell phone towers is another example. Many times cell phone towers, you see they go up on a building, they're leasing that space. So that would be the other income category. And just to keep it simple, I decided to use no other income. We're just going to go with the rental income on this property. So we have 0 income for other income here. And then that's going to give us our gross operating income. So we've looked at vacancy and credit losses. We've looked at other income. And now we have our gross operating income. And this brings us to our operating expenses. And that is the next line item. So what does operating expenses really look like on an investment property? Well, there's really 2 operating expenses that could be applied to a property. There's your recurring operating expenses. In other words, they happen recurring no matter what, either every month or every quarter or every year, for instance. And then there are your one-time expenses, like capital expenses. And that would be, say, a new roof or a new fence line or something that doesn't recur on a regular basis. It's really maybe a 1 in 10 or 1 in 20 year occurrence. Those are called capital expenses. We're not going to really focus on capital expenses in this talk because that generally is not included in the cash flow analysis. We're really just going to focus on recurring expenses. And again, those need to be annualized. So what kind of recurring expenses are typical? Well, the number one, highest one is usually property taxes. There's always going to be property taxes, and that's usually the highest expense. And when we look at property taxes, if we're analyzing the cash flow for the purpose of a sale, we generally use the property tax number that would be utilized under the purchase price, not what the current owner is paying, because their taxes are extremely low, especially if they bought couple decades ago, like many of my clients. We really look at what the property taxes are going to be based off the new purchase price. So that's how we generally itemize property taxes. Again, water bills are another one. On a single family, you can usually pass those bills right along to the tenant because there's only one tenant. But once you get to 2 units or more, the 5-unit apartment building, the 10-unit apartment building, it's hard to. There's usually only one water meter that is standard on a multifamily property because it's hard for them to submeter. When these properties were built, they were only allowed one water meter. So for the most part, typical is that the owner is paying that water bill. And that's an annual, or actually it's a bi-monthly expense that the water has to be paid. And that's usually a pretty big number and growing quickly because the price of water continues to go up, especially in a region like ours, where for the most part, we live in a desert and we have to transport a lot of that water into the region. So water is a big expense and there's usually only one meter. And that's again why utility billing is becoming popular. And we're going to do a podcast on utility billing for folks that are looking to learn more about it. The next one is your insurance premium. Obviously there's insurance that you have to pay, electricity and gas bill. Now that's usually a smaller number because of the fact that the electricity bill that an owner has to pay is generally for common areas. Same with gas, might be for the laundry room. There's going to be a trash bill, gardener, pest control, third-party property management. Third-party property management is always one of the higher bills on the list, and that comes right off of the potential rental income, the income that comes into the property. I'm sorry, the gross rental income that comes into the property. So that could be anywhere from 3% to 10%, depending on the size of the property, third-party property management. You have a sewer bill, you have repairs and replacements. Now, finally, on repairs and replacements, one thing about that is that that's not necessarily CapEx expenses, those big purchase items. This is just maintenance that happens over the course of time. And rather than trying to itemize it, the banks or the underwriters usually just apply a number of $5,000 per unit per year. And that's what's standard in our area. You could probably itemize this and figure out what that number is, but we usually use just a standard $5,000 per unit per year. And so those are your recurring expenses. In this situation, we're using $36,252 as recurring expenses, and that's going to be a ratio somewhere around 38 to 42%. So in other words, your expenses on a property should be somewhere between 38 and 42% of the gross operating income. That's healthy expenses. If it's really low, 25 to 30%, that's great. You're running really lean as an owner. You're doing a great job. However, what are you sacrificing there? You might not be maybe giving the common maintenance that needs to take care of these properties. You might be pulling too much out. If you're paying over 50% in expenses, then you're losing money, and you need to really reevaluate what those expenses are, because that typically will tell me that it's not being properly managed. So if you can keep that expense ratio somewhere between 38 and 42% for operating expenses, then you're doing a pretty good job. And then that brings us down to a very important number, net operating income. Net operating income. Net operating income is if there is no other debt involved. For instance, we're going to talk about debt service here. This would be what your return is on your property. If you were to buy a property cash or have no debt, this would be your annual return every year on your property. And we utilize this number to figure out what your valuation will be on a property. So it's an important number to write down, your NOI, your net operating income. So in this case, we're looking at $54,378 as net operating income. Again, that's your cash flow that's generated. It's used to determine the value of the property, but it does not include debt service. This is where a lot of folks get confused. And again, if you're interested in learning about the value of a rental property, check out the webinar that we've created called Determining the Value of a Rental Property. And this is where your net operating income is very important, because we need it to figure out that number. So finally, we get down to debt service. Now, what is debt service? Debt service is nothing more than a fancy commercial term for paying a mortgage or paying a loan that you have on the property. So this property, if we have a sales price of $1,420,000 and someone who's looking to put 40% down if they wanted to buy it, which would be $568,000, they would need to go out and get a loan in the amount of $852,000. And we just used a number of 4% for the interest rate. So your annual debt service, which is principal and interest, is $48,811. Now, the reason I stress the principal and interest is because a lot of times a mortgage payment, if it's a 1 to 4 unit building, will include principal, interest, tax, and insurance. But if you go back and look at our expenses, you notice that let's see, can I go back quickly here? Maybe not. You notice in our expenses that we've already included tax and insurance. We talked about that. Sorry, tried going back, but this system's a little too slow. So we already included taxes and insurance. So with annual debt service, we're only talking about principal and interest. We don't want to double charge in the cash flow analysis for taxes and insurance. So in this situation, your 12 months of debt service is $48,811. And that finally brings us to our bottom line number, your cash flow. Again, pre-tax, but this is your cash flow. So at the end of the day, this property that you own will generate pre-tax income after all those expenses are paid, after you analyze everything, of $5,567 a year. Now, I want to let that sink in, because a lot of times I sit down with owners and they think they're getting a lot more income than they are. But once you go through this entire process, you start off way up there at $95,400, but you go through the list, and by the time it comes out of the wash, so to speak, with all of the expenses that are involved, you're really only generating a pre-tax cash flow of $5,567. That's a surprise to a lot of folks, because they think they're they're getting 95,000, but the reality is we haven't really analyzed what their expenses are. The good news is this property is making money, which means it is not an investment alligator. At $5,567, it's still making a decent enough return cash flow wise that it is not digging into the owner's pocket on a monthly basis, which would give it the designation of the investment alligator. So I know that was fast. We talked about a lot of information, but here is what you learned. We discussed the cash flow analysis formula. We talked about potential rental income versus net rental income. We talked about what the typical expenses of a rental property are. And then, of course, we threw in a bonus. You learned a new term today. It's the investment alligator. So we covered a lot of information. It was a very quick webinar, but again, these smaller webinars are designed to cover information quickly. I am the rental realtor. And if you're not necessarily in my marketplace, as being a part of the CCIM network, as well as Keller Williams, which is the largest brokerage in the country, I have a network of strong professionals that I will refer you to that will be able to help you through the process of understanding how to evaluate your property. So here is my contact information directly. You have my phone number there. You have my contact info. And again, I will be sending this information out via email. So if you can't write it down right now, don't worry about it. You will get a chance to complete it. That's all I have for this webinar. Thank you for attending, and I hope you learned something, and I hope to see you again on one of our next webinars real soon. Take care, everybody.